What's going on, guys? I hope you're having a good weekend so far. We're going to take a look at a stock called DOUGH Limited, stock ticker DOU. Now, this is a company that's a neobank, and it's a mix between an AI company and a fintech, which probably more towards fintech, but it's the perfect micro-cap social media pump stock. It's a great story. Think of two better sectors to pump on social media than AI and fintech. Right, you've got the BNPLs in fintech, such as Afterpay, Zip, Sezzle, and then you've got BRN for the AI space, right? And then you mix them together and moonshot. So this pumped really nicely. And if I bring up the 5-minute chart, and it was just trending up. It's pretty much hard to lose money if you went long at any point since this company IPO'd, or sorry, RTO'd, it was a reverse takeover. So it was on a nice upwards trajectory, and we see a massive shooting star, complete rejection here on high volume, which is the first sign of things to come for this stock, I believe. Now, this isn't a recommendation to buy or sell this stock. I'm not a financial advisor. This isn't financial advice. What I am doing here is showing you guys how I look at the fundamentals of a company and why I think DOU is heavily overvalued. By heavily, I really can't emphasize enough how heavily overvalued I believe this stock is. Now, just because I believe it's undervalued, just because we look at the fundamentals and we see what a stock should be, doesn't mean that's where it will be, right? Those are two different things. So the point of this video is to look at the fundamentals. And if you were an investor, you would look at this and consider, what's the risk to reward? If I buy now, is my reward greater than my risk? And that's what I'm going to highlight to you guys today. Now, I don't know if this company goes to 50 cents. I don't know if it goes to $1, and I certainly don't know if it goes to $2. If we look at split it payments, when it launched, it shot up all the way to $2, and that stock I said was worth 20 cents. And it took a whole year to drop to 20 cents. So, you know, these things, just because you see a certain valuation doesn't mean that's where it'll go the next day or anything like that. So we're going to take a look at the annual report. First things first. Now, if you're wondering, where do I get these documentation pieces? This you can get from Hot Copper. You can get from the ASX website. All companies are required to put in certain documentation on the ASX website. So it's a centralized place you can go to get documentation for companies. Now, the first one we're going to look at is the Appendix 4E. So we scroll down, and a lot of people don't like to read this document because they don't understand it. It's a big financial piece, and a lot of it is really garbage. So if we scroll down to the part that matters, this part here, we're going to look at the Consolidated Statement of Profit and Loss, which is on page 26 of the Appendix 4E. Financials, this is what matters. This page and the next page. These two pages are always together. So once you find it, this is really the gold mine of understanding a company. Revenue, and then expenses. So revenue minus expenses, and that's your running cost of the business. Are you running a profitable company or not? And then you got other things as well, but we're going to take a look at this first. So revenues, the revenues have gone up. However, with the expenses on top, we're running at double the loss. So from $441,000 loss, and these brackets here, they indicate that this is a loss figure. So $441,000 loss in 2019 financial year, and 2020, we've got $1 million in losses. So it's, in terms of a growth story, yeah, look, we're looking at $7,000 to $65,000. One would look at that and go, okay, the revenues are increasing 6, 7, 8-fold, whatever. But when you look at the expenses, you got to be a little bit concerned. Now, this is a micro-cap stock, and financials for micro-caps typically don't look that great. But when you've got a company shooting from $20 to $30 million all the way up to $200 million, you know, you're going from a micro cap and you're starting to head into the small cap space, and one's got to look at it and go, well, is it financially sound? Because it's trending towards a space where it's not going to be a micro cap anymore. So one has to really consider looking at the financial documentation here. Loss after tax for the income year. So they've almost tripled their losses, $338,000 to $959,000. So that's what they're losing every year. Now, if one was to look at the trend and go, okay, from 338 to 959, what's next? Next financial year, is it going to be $3 million loss? One has to wonder. We scroll down, and this is my favorite part of a financial document. It really gives you an insight into what the company has. So we've got assets. Most of it is in cash. 1.6 mil down to 800,000. So they've halved their assets and they've lost a lot in terms of liability. They've tripled their liabilities. So $100,000 in liabilities to $300,000. Tripled liabilities, half their assets. You can already tell this isn't going well. We can look at the total net assets and they've lost about 60 to 65%. 1.5 mil to 0.5 basically. So it's not looking great. We scroll down, total equity has dropped significantly, 1.5 to $0.5 million. That's pretty much it from the financial document. You can already tell we've got a company that's sitting at $565,000 in equity. Now, keep in mind, as part of the reverse takeover, they did raise $6 million, and we'll go over that in the next document. So they're really at 6 million plus this amount here, this equity amount, because this is pre-IPO, pre-RTO. So they're sitting at 6.5 million in equity realistically. So let's go through the prospectus and I'll show you the part that matters. Now, they've had a raise between $4 to $6 million, and as I understand, they raised all $6 million. So if I just type in shares on issue, so again, this is a publicly available document. It's the prospectus. And on page 38 of the prospectus, we can see section 2.1, the offer. Total number of shares on issue, at a minimum will be 534 million. At maximum will be 601 million shares. And I do believe they raised all $6 million. So they should be about 600 million shares. So let's have a look at the market cap then. It's easy to just go on Hot Copper and just find the market cap, but I like to do it manually. Make sure I got the right information. So shares times 0.345, so that's the current share price, 34.5 cents. So we have 207 million market cap as of closing price on Friday. Now, when they RTO'd, they opened at 5 cents. So let's just do 601 million times 0.05. So at 5 cents, they opened up at 30 million market cap. So we have a company that's sitting at $6.5 million equity. 6.5 million equity, and they opened up at 30 mil market cap. Fair enough. Look, that's not horrendous. No, that's 5 times equity position. It's a little, probably a little high for a micro cap, considering they're losing money and quite a bit of money. They don't seem to have any trajectory of growth, and really what we're seeing is a rise in share price based on pure speculation and hype and momentum, of course. So again, this is simply a ridiculous valuation when we got 207 million divided by 6.5 million, which is the equity. So we're trading at 30 times equity effectively. So that's a pretty insane number for any of you guys who watch my previous videos on valuation of companies. When you're sitting at 5 to 6x, you better have a pretty good financial position. When you're sitting at 10x, you get a bit scary. You better have some serious growth, just like Afterpay was probably sitting at 20x, I believe. But with Afterpay, you know, you've got a massive growth story. Look at their revenue, look at their customers, look at every metric on Afterpay, and you go, okay, well, that makes sense. I can see why it's valued so much higher than its equity. And even though it's losing money, the growth trajectory is monstrous. Now, this market cap valuation of 200 million would be perfectly fine if there was equally a monstrous growth story, but we don't have that. We have 31 times equity, which is an insane valuation for what they have, and we'll dig into that a little bit further. Now, this is a broker report. I will put in the comment section or the description below where you can get and sign up to get broker reports if you're interested. Someone sent this to me today, and this is between 5th of the 10th to 9th of the 10th. So this is a little bit old data, right? This is a good 8-9 days old, or rather 1 trading week old. But it's worth noting just who's selling and who's buying. We want the net value position, so the buy minus the sell. And we have Commonwealth, which is the retailers, at $1.7 million. CMC Markets at $1.2 million. We've got Open Markets at $355,000. So we've got a lot of retailers buying in, but who's selling? Bell Potter, Finex, Hartley's, Morgan's, Patterson's at 4.4 mil, Pershing, right? We've got institutional money bailing in droves on this company. Bailing in droves. How much has Patterson's bought? Okay, so they sold significantly more than they've bought. Same with Morgan's, same with Hartley's, same with Finex, and same with Bell Potter. So what we're seeing is an absolute exodus of selling from institutional money being replaced with retail money. Now, where in the history has that ever been a good thing? Usually never. Now, I'll wait for a new broker report next week. It'll be good to see, especially when that massive dump happened from 50 cents or near 50 cents down to 30 cents, 37, whatever it was. So it'll be quite interesting to see the broker data for that week. And yeah, so look, this is just one piece of the puzzle, right? I would never recommend making investing or trading decision purely based on nothing but broker data. That's a terrible idea. It's just one piece of the puzzle that's worth considering. That institutional money, if you're an investor, you want institutional money piling in. You don't want them going out, basically. So let's take a look at some old news from DOUUGH. This is back in November 23rd, 2017. So about 3 years ago, they raised $2.5 million. But what has the company done since then, right? They've got a partnership with Choice Financials in the US. So in the last 3 years, what have they done? Maybe they were developing their app. Maybe they were developing their AI technology. But in effect, we'll look at the customers that they have and that they've managed to get. But for 3 years, it's a little concerning. So what we have here is a smart bank through a mobile-based platform powered by Sophie, which is, I imagine, their AI, a 24/7 personal money assistant. Are you fucking serious? An AI assistant? You want a 200 million market cap company for an app that tells you how to spend your money? How many apps out there exist like that? I get it. It's a neobank as well. It's not just the app, but who wants this shit? I know it's targeted at millennials, but millennials aren't that dumb. Sorry, they've got the internet. They know how to research financial competence. You can't get rid of financial incompetence, right? Whether you have an app or not, whether you have the digital age of the internet, people are still going to be dumb. Now, if we go a little bit more forward, this is originally where DOU was meant to be listed. They said they'll list in July last year, raised $10 million and plan to have 100,000 customers by June this year. Well, if we look at the company presentation, so if this is page 22 of DOU's latest announcement. This is just a company presentation, and it's a nice little propaganda piece like all company information, company announcements are. So if I scroll down, back down to here, we've got 1,000 customers. They were targeting to have 100,000 by a few months ago. So I guess I don't know what the cause of the delay was, but one has to look at that and go, wow, they missed their target by 99% effectively. So it's a bit concerning that a company was aiming to have so much in 1 year and just miss it by a significant mark. Now, I can't tell where or why that was delayed. So it's delayed because capital raising. The point is, they've got barely over 1,000 customers. So you've got a company that's targeting 100,000 within 1 year, right? That was their initial target, to be listed, have 100,000 customers, and it's just a fantasy target. You know, there's no trajectory, there's no suggestion that that's going to happen or anything like that. So we've got nothing to really base our expectations on for this company. You know, if these guys were running for a full year by now, and or even for a full quarter, we can see their growth. You know, they've gone from 0 customers to 10,000 to 50,000, and we can see the growth curve. What do we see now? We see nothing. You don't see a thing. We currently see that they have greater than 1,000 customers, which is basically meaningless. So there you go. There you have it. There's your company. Barely 1,000 customers. It's got 6.5 million in equity. It is currently valued at over 30 times equity, with 0 trajectory, 0 suggestion that it's going in a high growth phase or anything like that. It's pure speculation. This is pure speculation, nothing else. The company is probably worth around where it RTO'd. That's my opinion. I think it's worth somewhere in the 5 cent, maybe 6 cent range. That gives it a valuation of about 30 million. And what you've got is, you know, a neobank, despite the fact that ING, ME, and UBank are neobanks, right? This isn't a new concept. Sure, those aren't complete digital businesses, because even though they have no physical branches, they do rely on banking institutions for their company to function, basically. So neobank is trying to get away with that, or do away with that rather. So neobank is trying to be this 100% pure neobank of a company. If you guys want to learn more about neobank and what it is, go for it. I'm not gonna waste my time on information that you can get freely just about anywhere. I'm trying to give you the information that you're likely not going to get anywhere else. And hopefully I've opened your eyes to the financials, to the value of the company. I hope this has sort of shone a light on where it should be as opposed to where it is at the moment. And again, this is all about buy and sell demand, all right? So just because I think the stock is worth 5 to 6 cents doesn't mean it'll get there anytime soon. You know, there could be a bit of hype, there could be more retailers piling in. Ultimately, it is buyers versus sellers, and buyers are clearly dominating and pushing the stock up. So could this go to 50 cents? Yeah. Could it go to $1? Sure. Is it likely? No, I don't think so. The likelihood to swing back to the downside is far more likely than the upside. Now, fintechs are hot and AI is hot. So those things need to be taken into consideration. Ride the momentum if you're interested. Traders are going to love this. Absolutely, they're going to love it. All right? The momentum is huge to the upside. But if you're an investor, there's huge red flags. Huge red flags. If you want to put your money in a stock like this and you want to hold it for 6 months to 1 year, maybe 2 years, best of luck breaking even in that time. Anyway, guys, if you found this useful at all, please do consider hitting that subscribe button. That helps me out a lot. Otherwise, have a good rest of the weekend. Cheers, guys.